If you're watching this right now, pay attention because what I'm about to tell you might shake the very foundation of how you see money, markets, and the metals beneath your feet. Imagine waking up one day and realizing that something people took for granted, something as old as human civilization itself, is suddenly vanishing from the world. I'm talking about physical silver and the numbers, the vault drains, the global shortages, the price anomalies between COMEX and Shanghai. They are signaling something huge. I'm talking about a scenario so stark that many analysts, insiders, and even worried investors are asking, is a spike to $150 or even $200 per ounce inevitable? This is metal mindset, and if you care about your financial future, if you care about protecting yourself and your family from what might be coming next, make sure you hit that like button and smash subscribe. Turn on notifications so you don't miss anything we cover, because what we're unfolding today is critical. And as we walk through this story together, if anything here strikes you as powerful or disturbing, hit that share button and drop a comment. Let us know what part shocked you the most. We want to hear from you. Let's begin with the shocking truth. Physical silver is disappearing fast. Not in some distant theory, not in some back-of-the-envelope imagination, but in actual vaults, in bank storages, in mints, and in trading centers around the world. We'll talk about why this is happening, how it's connected to massive institutional demands, and why the paper market, especially the COMEX, may be wildly misrepresenting the real-world supply. Most importantly, we'll explain why this could lead to an explosive price surge that very few mainstream observers are even talking about. Now, before we go deeper, let's clear something up. There are two markets for silver. One is the physical market, coins, bars, bullion that you can hold in your hand, store at home, or keep in private vaults. The other is the paper market, futures contracts, ETFs, COMEX, trading essentially promises or claims on silver, often without actual physical backing. In normal times, these two markets are loosely tied together. But right now, they are dangerously out of sync. For years, banks, hedge funds, and financial institutions have been shorting silver, betting that the price would go down, often without owning the actual metal. Meanwhile, demand for physical silver, especially in places like China, India, and the rest of Asia, has skyrocketed. People are buying physical silver coins and bars at rates we haven't seen in decades. But here's the crazy part. While this demand has surged, the actual physical inventory has been shrinking. Think about that for a moment. You have more buyers than ever before. Everyday people, savvy investors, industrial buyers, central banks all seeking physical silver, while the amount available to buy is shrinking. Basic economics tells us that when demand outpaces supply, prices go up. That's simple. But in the case of silver, we might not be talking about a gentle rise. We could be talking about a steep spike. And that's not speculation. That's what the data is increasingly suggesting. Let's consider the vaults that matter. COMEX warehouses hold a significant portion of the silver supposedly available to back futures contracts. But in recent years, deliveries from these warehouses have been consistently drained. Physical silver has been leaving these vaults faster than it's coming in. Bars are being moved, shipped, claimed, and in many cases simply disappearing from the inventories that were once counted as part of the available supply. At the same time, facilities in Shanghai and other Asian markets are reporting shortages of their own. Silver that is supposed to be available for settlement isn't showing up. Delivery requests go unfilled. Premiums on physical silver products, meaning the extra amount over the spot price that buyers are willing to pay, are higher than normal. When premiums rise, that's a clear signal that buyers are willing to pay more just to get physical metal in hand. This mismatch between paper and physical is where things start to get dangerous. On paper, silver prices might look tame, stuck in the same range for months or even years. But on the ground, real people and real institutions are willing to pay much more for physical silver. That gap between the paper price and the real-world price is growing. And as that gap grows, the potential for price instability skyrockets. Now let's talk about the heart of the current crisis, the COMEX silver market. COMEX is a futures exchange, where traders buy and sell contracts for silver to be delivered at a future date. Historically, some portion of these contracts was backed by actual metal sitting in vaults. But over time, the vast majority of silver trading has become purely paper contracts traded without any intention of ever exchanging the physical metal. Why does this matter? Because if too many of these paper contracts are called for delivery at once, meaning traders demand the physical metal they claim to own, the system could be stretched beyond its limits. This isn't hypothetical. Throughout history, there have been moments when the paper claims on a commodity exceeded the available physical supply. When that happens, prices spike. And the larger the gap between paper claims and physical supply, the more dramatic the spike can be. Right now, there are more outstanding silver contracts than there is metal available to fulfill them. This isn't a secret. It's just not widely understood outside of metal market insiders. Silver shortages are real, and the evidence is in the shrinking vault inventories, rising premiums, delivery failures, and increased long-term contracts being held without physical backing. You might be wondering, okay, but why isn't the price already skyrocketing if this is happening? Great question. Here's where the concept of market suppression comes in. Big financial players, banks, hedge funds, traders with massive positions have incentives to keep prices low. When prices stay low, these institutions can maintain their short positions without triggering margin calls or losing money. They benefit from a price that stays subdued, even in the face of real supply constraints. These players use the paper market to influence prices. They trade futures, contracts, create enormous paper positions, and even engage in strategies that can temporarily push prices down or keep them contained. But paper games only work as long as the physical market can absorb the pressure. Once too many holders demand real metal, the paper market's ability to suppress prices falters. Let's bring this closer to reality. Imagine you are a silver investor. You want physical metal, bars, coins, rounds, something you can touch, store, and hold. You go to buy it, but your dealer tells you delivery times are delayed, premiums are higher, stock is low or out of inventory. Sound familiar? That's because dealers around the world are reporting exactly these issues. Physical silver inventories are low, mill products are being claimed before they even arrive, and premiums, the extra cost over spot, are climbing. At the same time, big industrial players, manufacturers who use silver in solar panels, electronics, medical equipment, and more, are locking in supply. They don't care about the paper price. They need the real thing. When industrial demand collides with investor demand, the pressure on available supply becomes immense. Now let's talk about China, one of the biggest players in the silver market today. Chinese demand for physical silver, especially through Shanghai's trading exchanges, is unprecedented. Chinese traders are willing to take delivery of silver. They are taking metal off the market and holding it. This removes supply from the global pool. Meanwhile, trading volumes in Shanghai have soared. When traders take delivery in Shanghai, they are effectively converting paper claims into physical holdings, drying up supply that was once available for global trade. And this brings us to the next point: price discovery in a normal market. Price discovery, the process through which the market finds the price based on supply and demand, happens with physical trading. But right now, price discovery is being distorted by the divergence between paper, futures, prices, and physical premiums. The COMEX price might remain in a narrow range, but the real price, the price people are willing to pay for physical silver, could be much higher. This creates a hidden undercurrent that doesn't show up on standard price charts, but is very real in terms of market pressure. At this point, some of you might be asking, is a move to $150, $200, or beyond even plausible? It might sound extreme, but if you look at the fundamentals, shrinking inventories, rising global demand, distorted price signals, and leveraged paper markets, you begin to see why such a scenario is being considered by serious metal analysts. In a supply-constrained world, prices don't just inch up. They can spike violently when the market finally adjusts, and let's be clear, this isn't just about investors or speculators. A spike to $150 or $200 per ounce would have real consequences for industries around the world that rely on silver. It would affect electronics manufacturers, solar panel producers, medical device companies. The ripple effects would be profound. But here's the part that most mainstream commentators won't tell you. We might already be in the early stages of this event. The supply crunch is not a future possibility, it's happening now. The evidence is everywhere if you know where to look. Vault inventories falling, premiums rising, delivery waits lengthening, contract backlogs, and rising Asian demand. So what does this mean for you? First, understand that this isn't a drill. This is not another silver $250 prediction. We are talking about a potentially structural shift in how silver is priced, traded, and held worldwide. If the physical supply continues to tighten while demand increases, prices won't slowly drift upward, they could surge. Second, this is a personal awareness moment. You don't have to be a billionaire. You don't need a PhD in economics to protect yourself. You just need to understand that real assets, physical assets, behave differently than paper claims. When confidence in paper markets erodes, people turn to what they can hold. That's why gold and silver have survived for thousands of years as stores of value. And right now, silver is under pressure because so much of it is promised on paper and so little exists physically where buyers can get it. Third, you should pay attention to premiums and physical availability. These are not just dealer complaints, they are signals. When dealers charge higher premiums, it means the market is telling you there's more demand than supply. You don't see that in the paper price, but you see it in real life. Now I want to take a moment and ask you to do something important. If this information is opening your eyes, if you're starting to see the gap between the physical reality and the paper price narrative, go down to the comments right now and type, "I see the silver squeeze." Let's get a conversation going. Share this video with someone who still thinks silver is just another commodity. Bring them into this discussion. The more we talk about this, the more people will start to see what's really going on. Because here's the truth. Markets move most dramatically when the majority of people are still asleep. When fear starts to replace skepticism, we're in a new phase. So what are the possible triggers for an actual price explosion? One big trigger would be a breakdown in the COMEX delivery system. If a large number of holders demand physical delivery instead of settling in cash, if that happens, then the paper market could be forced to honor those claims, and the limited physical supply would struggle to keep up. That's where prices could start to spike rapidly. Another trigger could be government action. If major governments start reallocating silver stockpiles, restricting exports, or intervening in markets for strategic reasons, supply could tighten even further. Silver is not just an investment metal, it's a strategic metal. It's used in electronics, defense, medical technologies, and renewable energy. Governments understand this, and in times of crisis, strategic resources become even more tightly controlled. Let's not forget inflation and currency risk. In times when paper currencies lose purchasing power, real assets like precious metals tend to rise. If inflation accelerates, or if confidence in major currencies wavers, investors may flock to physical silver and gold. But unlike gold, silver has a much smaller above-ground stock. There's simply less of it available. That means pressure on silver could be even more intense. So where does that leave us today? We're in a world where physical silver inventories are shrinking, demand is increasing, paper prices don't reflect the real scarcity, and huge numbers of contracts exist without corresponding physical backing. That's a recipe for volatility and potentially for rapid price movement. Before we wrap up, I want to stress one thing. This isn't fear-mongering. Let's stay grounded in data, in observable market behavior, in actual inventory trends. The signs of scarcity are measurable, the premiums are quantifiable, the delivery backlogs and shortages are reported by dealers and exchanges around the world. This isn't theory, it's happening. If you're taking this seriously, you owe it to yourself to explore these dynamics further, to educate yourself on physical versus paper markets, to understand how supply and demand work when real metal is in play. And if you found value in this video, make sure you like, subscribe, and hit that bell so you don't miss our future deep dives into these critical topics. Now, before we finish, we want to hear from you. Do you think silver is heading to $150 or $200, or is this whole idea overblown? Drop your thoughts in the comments, engage with others. Let's make Metal Mindset a place where serious investors can talk real metal and real markets. And if this video gave you a new perspective, share it with someone who needs to understand the truth about physical silver shortages. The conversation starts with you. Thanks for watching. Stay curious, stay prepared, and keep thinking with a metal mindset.